In today's video, we are breaking down Morgan Stanley's Andrew Slimmon and his take on the recent AI tech sell-off and what it really means for investors. Slimmon, who is a senior portfolio manager at Morgan Stanley Investment Management, joined CNBC's Squawk Box to discuss the latest market trends, the ongoing sell-off in tech, and the state of the AI trade. His key message was clear when he said, "This AI tech sell-off is a healthy opportunity for the markets." First, I will show you the clip of Andrew Slimmon speaking on CNBC. Then I will give you my detailed reaction and breakdown of everything he said and what it actually means for investors right now. After that, I will go further and highlight two top growth stocks that I believe are worth watching in this environment. So with that said, let's hear what Andrew Slimmon had to say. Andrew Slimmon's argument throughout the interview was that this sell-off should not be viewed as a warning sign that the AI boom is ending. Instead, he sees it as a healthy and necessary correction within a much larger trend that remains intact. What stood out to me immediately was his distinction between expensive and crowded. A lot of investors use those two words interchangeably, but Slimmon doesn't. He acknowledges that AI-related stocks have become crowded. In other words, too many investors have piled into the same trade. Momentum traders have rushed into the sector because these stocks keep going higher. When that happens, even great companies become vulnerable to sudden pullbacks because there are simply too many people on the same side of the boat. But crowded does not automatically mean overvalued. That's the key point he keeps coming back to. In his view, the earnings growth generated by many of these AI beneficiaries has actually justified much of their stock price appreciation. The stocks have risen dramatically, but earnings estimates have risen dramatically too. And honestly, I think that's an important distinction that often gets lost in the financial media. Many headlines focus on how much a stock has gone up, but they rarely focus on whether the underlying business has improved just as much. A stock doubling can absolutely be irrational, but if earnings double at the same time, then the valuation may not have changed much at all. That is essentially what Slimmon is saying. He's arguing that the market is behaving far more rationally than many people believe. One of the most interesting parts of the discussion was when he addressed the comparison everyone keeps making between today's AI boom and the dot-com bubble of the late 1990s. This comparison comes up constantly. Every time AI stocks surge higher, someone inevitably pulls out a chart comparing today's market to 1999. Slimmon doesn't completely reject the comparison. In fact, he thinks there are similarities, but he also thinks there is one enormous difference. The companies leading today's AI revolution are making huge profits. Back in the late 1990s, many internet companies had little or no earnings at all. Investors were often buying pure dreams and speculation. Valuations became detached from reality because there were no profits to anchor expectations. Today, many of the companies driving AI adoption are some of the most profitable businesses in history. Think about companies like Nvidia, Meta, Microsoft, Alphabet, and others. These companies are generating billions of dollars in cash flow while simultaneously investing heavily in AI infrastructure. That makes this environment fundamentally different from the dot-com era, and I have to say I agree with Slimmon on this point. That doesn't mean there won't be volatility. It doesn't mean stocks can't get ahead of themselves. But when you compare a company generating tens of billions in annual profits to a company in 1999 that was losing money and barely generating revenue, you're talking about two very different situations. Another fascinating topic was the debate surrounding capital spending. A lot of Wall Street analysts have become increasingly concerned about the enormous amount of money being poured into AI infrastructure. Meta alone has committed staggering amounts of capital toward data centers, chips, and AI development. Microsoft continues to spend aggressively. Alphabet is spending aggressively. Amazon is spending aggressively. To some investors, these expenditures look alarming because they reduce free cash flow in the short term. But Slimmon essentially asks a simple question: who are you going to trust? The smartest technology executives in the world, or Wall Street analysts focused on quarterly cash flow metrics? That may sound oversimplified, but there is a powerful idea behind it. The people running these companies have access to information that most investors don't. They can see customer demand, they can see compute shortages, they can see future AI adoption trends, and according to Slimmon, virtually all of them are telling investors the same thing. Demand for computing power remains significantly higher than available supply. If that's true, then these investments aren't reckless spending. They're strategic investments designed to capture future growth. Personally, I think investors should pay close attention to what management teams are doing with their money. Executives can say whatever they want on earnings calls, but capital allocation reveals what they actually believe. If multiple technology giants are simultaneously committing hundreds of billions of dollars toward AI infrastructure, that tells me they see a much larger opportunity ahead than what the market may currently be pricing in. Another important concept Slimmon introduces is the idea of AI beneficiaries. This is where the conversation gets particularly interesting, because he's not just talking about buying the obvious names, he's talking about investing throughout the AI ecosystem. The example discussed during the interview was Philippe Lafond's investment approach. Rather than focusing exclusively on the largest technology companies, he's looking at the businesses that benefit from all the spending taking place. Think about the companies manufacturing semiconductor equipment. Think about the companies supplying critical infrastructure. Think about companies involved in data centers, networking equipment, power systems, cooling technologies, and memory chips. These businesses may not always dominate headlines, but they are positioned to benefit from the enormous wave of AI spending flowing through the economy. And honestly, this is an area where I think many retail investors miss opportunities. Everyone wants to own the obvious winners. Everyone wants the next Nvidia. But sometimes the better investment is the company selling the picks and shovels during a gold rush. Slimmon seems to be suggesting exactly that. What also caught my attention was his discussion about portfolio construction. Even though he's optimistic about AI, he's very careful not to recommend concentrating an entire portfolio in the sector. That is a subtle but extremely important point. There's a tendency during powerful bull markets to assume that whatever is working today will continue working forever. Investors become overconfident. Diversification starts feeling unnecessary. Then a day like this arrives and suddenly everyone remembers why risk management matters. Slimmon recommends maintaining non-correlated positions. In practical terms, that means owning assets or sectors that don't necessarily move in lockstep with AI stocks. He specifically mentions financials as an area that may continue performing well even if AI names experience temporary volatility. His reasoning is straightforward. Many financial companies have been delivering strong earnings results, but their stock prices have not enjoyed the same level of enthusiasm that AI stocks have received. As a result, there may be opportunities outside the technology sector that investors are overlooking. I actually think this may be one of the most valuable lessons from the entire interview. You don't have to choose between AI and everything else. You can be bullish on AI while still maintaining exposure to other sectors. Those positions can act as shock absorbers during periods of volatility. Toward the end of the interview, the conversation shifted toward earnings revisions, and this may be the most important bullish argument Slimmon makes. He repeatedly emphasizes that earnings expectations continue moving higher. Quarter after quarter, companies have been outperforming analyst forecasts. When that happens, analysts are forced to revise future earnings estimates upward. This creates a powerful feedback loop. Higher earnings support higher stock prices. Higher earnings estimates support future valuations, and as long as that process continues, the market can keep advancing without necessarily becoming more expensive. This is where Slimmon becomes noticeably optimistic. He points out that earnings expectations for the S&P 500 have increased substantially. The market isn't simply rising because investors are willing to pay more for the same profits. The market is rising because projected profits themselves are increasing. That distinction matters enormously. One of the biggest mistakes investors make is focusing exclusively on price while ignoring earnings. Price tells you what investors are paying today. Earnings tell you what investors are actually buying. If earnings keep rising, then higher stock prices become much easier to justify. When Becky Quick presses him on how much longer this can continue, Slimmon gives what I think is a refreshingly honest answer. He doesn't know, and neither does anyone else. I appreciated that answer because too many market experts pretend they can pinpoint the exact top of a cycle. History shows that's nearly impossible. Instead of predicting an exact ending, Slimmon focuses on the evidence available today. And the evidence he sees remains positive. Companies continue beating expectations. Analysts continue raising forecasts. Corporate investment remains strong. Demand for AI infrastructure remains robust. None of those factors suggest an imminent collapse. Now, that doesn't mean investors should expect a straight line higher. In fact, one of the major themes of this interview is that pullbacks are normal. They're healthy. They're necessary. Markets need periods of consolidation. Markets need moments where excessive optimism gets reset. Without those corrections, bubbles become more dangerous. That's why Slimmon actually welcomes these sell-offs. He sees them as pressure release valves rather than signs of systemic weakness. My overall takeaway from this interview is that Andrew Slimmon remains firmly bullish on the AI investment theme, but he's doing so from a position grounded in earnings growth rather than hype. He's not arguing that stocks should rise simply because AI is exciting. He's arguing that earnings growth is validating much of the enthusiasm. He acknowledges the risks. He acknowledges the crowding. He acknowledges the volatility. But he continues to believe that the fundamental drivers behind AI remain intact. And personally, I think that's probably the most balanced way to view this market right now. It's possible to recognize that some stocks have run very far, very fast. It's possible to acknowledge that sharp pullbacks can and will happen. But it's also possible to recognize that we're still in the early stages of what could become one of the most transformative technology cycles in decades. Whether Slimmon ultimately proves right or wrong, his central message is clear. Don't confuse volatility with a broken thesis. A crowded trade can correct sharply without changing the long-term opportunity. And as long as earnings continue surprising to the upside, the AI story may still have much more room to run than many investors currently believe. Now let's break down the two powerful growth stocks that are positioned right at the center of the biggest infrastructure build-out happening in the market today. One is quietly becoming the backbone of AI data center expansion, and the other is solving one of the most urgent problems in the entire AI revolution: power. The first company we need to talk about is Vertiv Holdings, with the ticker VRT. If you want to understand why Vertiv matters, you need to zoom out and look at what AI actually requires at scale. Modern AI chips are not just faster processors, they are extremely power-dense systems that generate enormous amounts of heat inside tightly packed racks of servers. Traditional cooling methods are simply not enough anymore. This is where Vertiv steps in, and this is where the story becomes far more interesting than most investors realize. Vertiv is not just selling cooling equipment, it is building the thermal and power infrastructure that makes AI data centers physically possible. Its liquid cooling systems are designed to remove heat directly from chips at the rack level. That is a critical shift because air cooling alone cannot handle the heat generated by next-generation AI workloads. But the company does not stop there. Vertiv also provides cooling systems, chillers, uninterruptible power systems, switchboards, and backup power infrastructure. In simple terms, it sits at the center of making sure massive AI facilities stay powered, stable, and operational at all times. And right now, demand is not just strong, it is accelerating at a level the company itself is describing as unprecedented. In the most recent quarter, Vertiv reported sales of $2.6 billion, which represents a 30% increase year over year. That is not slow, steady growth. That is acceleration inside an already massive industrial buildout. Looking ahead, management is projecting full-year sales between $13.5 billion and $14 billion. At the midpoint, that represents roughly 30% growth. Even more important than revenue, the company is expecting free cash flow between $2.1 billion and $2.3 billion. That matters because in infrastructure businesses like this, cash flow is what ultimately funds expansion, innovation, and shareholder returns. But what really stands out is not just the numbers, but the visibility. According to management, there is an increasing sense of urgency among hyperscale customers. Orders are getting larger, more complex, and more forward-locked than ever before. In fact, backlog durations are extending to 12 to 18 months, which gives Vertiv unusual visibility into earnings well into 2027. Think about what that actually means. This is not a company guessing what demand might look like next quarter. This is a company with multi-year order visibility already partially locked in. On top of that, management has explained that a large portion of recent orders will be delivered in the second half of this year, which is expected to accelerate growth even further as production ramps. And here is where the investment story starts to compound. Vertiv is actively increasing capital expenditures to expand production capacity. That capacity is expected to come online in the second half of the year. So you are not just seeing demand growth, you are seeing supply expansion designed specifically to meet that demand. Now here is a forward-looking catalyst that many investors are not fully pricing in yet. Vertiv expects a major transition toward 800-volt DC architecture in the coming years. This matters because higher voltage systems fundamentally change how AI data centers are designed. They allow more efficient power delivery at higher densities, which directly expands the total addressable market for Vertiv's cooling and power solutions. The company is already preparing for this shift by developing prototypes and expanding its product portfolio. If this transition plays out the way management expects, Vertiv is not just selling into today's data center build-out, it is positioning itself for the next generation of AI infrastructure design. So when you put it all together, you are looking at a company sitting at the intersection of three powerful forces: exploding AI compute demand, structural limitations in existing cooling and power systems, and a long-term architectural shift in how data centers are built. That combination is exactly why Vertiv is being viewed as a key infrastructure beneficiary of the AI era. And in my view, what makes this even more compelling is that this is not speculative demand. This is already showing up in revenue, backlog, and capacity expansion decisions today. But before we move on, there is an important takeaway here that I want to emphasize. When markets get excited about AI, most people think about software. They think about apps, models, and platforms. but the real constraint is physical infrastructure. Power, cooling, and energy delivery are becoming the bottlenecks of the entire system, and companies that solve bottlenecks tend to become some of the most important long-term compounders in a cycle like this. Now I want to pause right here before we move into the second company. If this resonates with you, you are exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you do not miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move into the second company, and this one tackles a completely different but equally critical bottleneck in the AI revolution. Not cooling, not hardware efficiency, but power itself. The company is Bloom Energy with the ticker BE. If Vertiv is about keeping AI data centers cool and operational, Bloom Energy is about making sure they can actually get enough electricity to run in the first place. And this is where the story becomes extremely important, because power availability is quickly becoming one of the biggest constraints in the entire AI build-out cycle. Bloom Energy builds solid oxide fuel cell systems that generate electricity on site. These systems are called Bloom Energy servers, and they can run on multiple fuels including natural gas, biogas, and hydrogen. What makes them especially relevant right now is not just their technology, but their ability to bypass traditional power grid limitations. This is what the industry calls behind-the-meter power. Instead of waiting years for utility interconnection approvals and grid upgrades, companies can install Bloom Energy systems directly at their facilities and generate their own electricity. And that time advantage is becoming absolutely critical. In some regions, grid interconnection delays can stretch up to 5 years. At the same time, AI data centers are being built at a speed that far exceeds the ability of local utilities to expand capacity. That mismatch is creating a massive gap between power demand and power availability. Bloom Energy is stepping directly into that gap, and the demand is already showing up in the financial results. In the first quarter, revenue surged 130% year-over-year to $751 million. That is not incremental growth. That is a sharp acceleration in demand for distributed power systems. Even more importantly, the company is starting to show operating leverage. Operating income improved by $91 million year-over-year, reaching $72 million. That shift from heavy losses toward profitability is a key milestone for any growth company transitioning into scale mode. For the full year, Bloom Energy is projecting revenue between $3.4 billion and $3.8 billion, with adjusted earnings per share of around $2.05 at the midpoint. But the most interesting part of the story is not just what they are earning today, it is how fast demand is expanding from hyperscale customers. Large AI infrastructure players are increasingly adopting behind-the-meter solutions because traditional power grids simply cannot keep up. This is not a minor inconvenience. It is a structural constraint on AI expansion. If a data center cannot get power, it cannot operate. And if it cannot operate, the entire AI deployment slows down. Bloom Energy is benefiting directly from this bottleneck. The company has already secured major commercial relationships, including expanded deals with Oracle and a significant 10-year agreement with Nebius Group, which is backed by NVIDIA and focused on building AI cloud infrastructure. That contract alone is reportedly valued at up to $2.6 billion. This is where the long-term narrative becomes very clear. Bloom Energy is not just selling fuel cells. It is becoming an alternative power infrastructure layer for AI-driven computing demand. And what makes this even more compelling is manufacturing scale. The company currently has the capacity to produce up to 5 gigawatts of power systems annually, and management is actively expanding that capacity at a pace of hundreds of megawatts per quarter. That kind of scaling is critical because demand is not theoretical anymore. It is already arriving through contracts, backlog growth, and hyperscaler partnerships. Now here is the bigger structural picture. The AI revolution is not just a software story, it is an energy story. Every increase in compute demand translates directly into higher electricity demand, and unlike software, electricity cannot be compressed, optimized, or delayed without consequences. This is why companies like Bloom Energy are gaining so much attention. They are not dependent on grid expansion timelines. They are providing a parallel energy system that can be deployed wherever demand appears. And when you combine that with their improving financial performance, expanding customer base, and growing manufacturing capacity, you start to see why investors are treating this as a serious long-term growth story rather than a speculative energy play. In my view, what is most interesting about Bloom Energy is that it sits at the intersection of two massive trends. The first is the explosion of AI infrastructure demand. The second is the global strain on traditional energy systems. When those two forces collide, companies that can solve immediate power constraints become strategically important almost overnight. And that is exactly what we are seeing play out. Now, stepping back and looking at both companies together, the connection becomes very clear. Vertiv is solving the heat and infrastructure problem inside data centers. Bloom Energy is solving the power supply problem outside data centers. Together, they represent two essential layers of the same AI build-out cycle. One ensures the machines can run efficiently, the other ensures they can run at all. This is why infrastructure investing during technology shifts often becomes more powerful than betting purely on software winners, because without the infrastructure layer, nothing else scales. Now before we finish, there is an important sponsorship message. This video is brought to you by Value Stocks Investing Master Course. If you are looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now here is the key question I want to leave you with. Between Vertiv and Bloom Energy, which do you think has the stronger long-term competitive advantage in the AI infrastructure build-out, the company solving cooling and compute stability, or the company solving the energy bottleneck that makes all of it possible? Let me know your thoughts in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.